Okay, this this live streaming thing, man. OBS is always wrestling with me. All right, so, well, good afternoon. This is going to be one of those secret lessons nobody pays attention to when I'm going to tell you we'll meet again. And if they don't see me show up on a live stream in the morning session, they assume I'm not live stream when I say I was going to be here at 1:30 today. So we're just going to hang out. I'm going to do a audio check here. I'll probably just hurt your ears with that. Hello, testing 1 2 3, testing 1 2 3. Audio check. That should be good. Alrighty. So we are looking at the afternoon, what transpired today. I hung out with Tanya Trade's live stream community this morning. And some of the things you can go back and look at her live stream, you'll see. Click the little timestamp feature in their chat. And you'll see I outlined these things before it happened. Okay, so I'm going to teach a little bit about what the range showed today. A little bit more on the opening range gap. On the opening range, I'm going to revisit the idea of first presentation for the fair value gap between 9:30 and 10 o'clock. And then we're just going to calmly just chill out and hang out and watch what the afternoon does going into the final hour of trading. I'll be doing the most talking around what's already happened. So it's kind of anchoring what I've already taught so you can see it. And that way you're being prompted as to what you should be annotating, Caleb. So what your chart should look like, don't use dads. Make your charts look like mine or as close as you can. And just listen to what I outline as were for the most salient points. On the right-hand side, you see a 15-second chart. And on the left-hand side, you see a 1-minute chart. So we're not going to be using anything outside of those two time frames. I'm hopefully going to be able to see some kind of price runs this afternoon that we can watch, and we can observe it through the 1 minute and the 15-second in kind of like in unison. Probably heard Bailey. All right, give me one more second here. I'm going to place you on mute just for a second. All right, apologize for that. It's the things that can go wrong while you're live streaming. You got 3 dogs? Yep, everybody's going to know it. You're going to hear them in the live stream. So, I received a lot of comments and concerns about the 9:30 to 10 o'clock in the morning New York local time and the first presentation or the first formation of a fair value gap. And some of you are not listening. You're rushing through the videos, or you're probably listening to someone else that has taken a piece of the lectures and shared it with you. And it's not the same thing as going through the lecture yourself. taking your time, taking your notes, and trying not to rush. And there's a lot of you that are saying you're trying to catch up. You don't need to catch up, okay? Everything I'm teaching, just relax, because it's the same stuff all the time. It's not like you have to have that lesson at that given moment and that's the only time it's useful. If it's a concept and it's rooted on sound logic, it'll repeat. You don't need to see it at the very moment I'm outlining it. Okay, so you have the benefit of watching it as if it were here live. So there's no advantage or disadvantage, okay? Because that's the point of showing it to you with these time frames and these charts. So that way you have the same experience as if it were you were sitting here, okay? All right, so for now, let me just annotate this. Okay, so if you look at what we are trading around, we have Tuesday's daily low. I mentioned this yesterday in the live stream. I was talking about how if you note the previous day's highs and lows, you're never going to run out of setups if you do that. And if you look at the last 3 days, the high and the low of the last 3 days, the liquidity above or below those respective levels are going to be referred to again, even though they may have gone through and below a previous day's low, or the low 2 days ago, or the low 3 days ago. The algorithm will refer back to those price points. Because, well, let me ask you a question. Why do you think, what would be the reason for having a higher low noted on your chart from 3 days ago, even if yesterday or the day before it traded above it or below it? In other words, it's already hit those stops. What's the benefit of having that? What's the benefit of having that on your chart, or even referring to it as a liquidity pool, algorithmic reference point, a PD array? What's the significance of having that? Because wouldn't it be useless if the market has already hit the stops above a previous day's high or hit the stops below a previous day's low? Wouldn't that kind of like negate any further interest in that level? If you use retail logic where it's one and done, that type of thing, then that would be true, but it's not true from the stance of the algorithm. The algorithm does not know how many stops, how many actual orders are in the marketplace. It does not know that. It doesn't need to know that. It just needs to know what that reference point is based on time, which we're referencing by the interval of a daily high and a daily low. So having that old reference point, it will refer back to that same level again, because it has been coded to understand that any fluctuation in price, moving higher or lower, stops will be adjusted on an institutional level, very large level, okay, not intraday day traders, but deep pocket, large speculators. They'll have buying and selling interests around those levels. So because the algorithm doesn't have to know, and because the open interest above or below those levels with real pending orders and interest to be buying and selling around them, it's dynamic. See that? Isn't that pretty? The interest of returning back to those levels by the algorithm allows and affords market participants to capitalize on the price fluctuations that are immediately after that level is traded to, because it's told to trade there because the coder has built in the logic that there will be buying and selling resting below old lows. So if it's below an old daily low, and or a low that's 2 days ago, or a low that's 3 days ago. So it builds in, from a coder's stance, a perspective, it makes allowance for trending models. Everyone that considers themselves bullish, as the market makes a higher low, the stop losses will be trailed just below the lows. So the algorithm doesn't need to know how many orders are resting below an old low or above an old high. It doesn't need to do those things. It just simply needs to know where the high and the low is based on time. Time is the daily interval. So having your levels on your chart, the highest high and the lowest low, referring to the daily candlesticks, whatever that high is and that low is, by you having a line on a chart, which is what I have up here. Bear with me 1 second, okay? The perils of live streaming. This is all the stuff gets edited out, usually. Well, you're just going to have to endure that because I have a delivery being made here. So it is what it is. It's free. So just accept the fact that you're going to probably hear puppies in the background barking. So if we have our levels noted, the last 3 days, high and low, we can comfortably use those levels for draws on liquidity. They also can be catalysts for turtle soup. In other words, a break above a previous high when you're bearish. That would be a wonderful area to get short on a daily chart, and you don't even need to be a day trader. Like you can use that as a intermediate term, long-term position trader. Say you want to learn how to use this information, but you don't really want to be in here on a 15-second chart. I understand that it doesn't meet the interests for all of you as aspiring traders, and you want to use a higher time frame chart. Well, the same things that's being shown on these smaller time frame charts is available to you using a daily chart and a weekly chart and a monthly chart. It just means that you're going to have to wait a whole lot more time for those conditions to be met and the opportunity to present itself. As a teacher and a high frequency trader, I can use these time frames to kill two birds with one stone. One, I can teach with lots of examples, and it gives you a plethora of examples every single day for you to go in and study. Then you have the element of execution. Plenty of setups for you to engage. So from a teacher's perspective, I have lots of ample supply of saying, here's an opportunity to study this. Here's an opportunity to study that. And it repeats a lot because there's a lot of candlesticks and a lot of smaller little micro market structure that you can employ and practice in, study, tape read, whatnot. But as a trader, once you understand what you're looking for, you can trade a lot in these lower time frames. And it's not important for you to have the same expectation in terms of monstrous price moves that you would expect on the daily and weekly and monthly charts, but looking for surgical strikes that allow you and to afford you an opportunity to get in, take some measurable risk that's worth it, and then finding an opportunity where the price can displace and reach for a pool of liquidity or inefficiency. So having Tuesday's low annotated over here, this level here is this level here on the 15-second chart. This high right here on the right-hand side chart represents this high right here on the chart on the left, which is the 1 minute. It trades exactly to the high of the sell side imbalance, buy side inefficiency. Admittedly, I'm very distracted because we're having another deep freezer delivered, and they're here, and I don't like when people are in my home. I hear them down there, so I'm wondering if my wife is jumping on them about getting to the place where I want that freezer placed, and if they're wearing their coveralls for their shoes, because we don't wear shoes in our house, and it's driving me nuts right now thinking about it. So here the fluctuation is around Tuesday's low. So back here, we can use this order flow here, and let me scrub this over here a little bit. We'll come back to it. So we have a small little gap here, and we have an order block. This entire candlestick right there. The market breaks down, trades up, fills in this area here, overshoots it a little bit, but stays inside of the order block, which is the up close candle. It should be a little bit easier to see now. And then drives strongly down into Tuesday's low. Then it rallies once more, wicks above it a little bit, and then dives once more lower. If you're targeting old lows like that, if it's a daily low, I do not like to do this with intraday lows. Okay, so make sure you're in your notes, you're recording this. Intraday lows, that means it's a low that's formed inside the range of the highest high and the lowest low, and it has not made a lower low on the day, but it's just, you're taking a partial, okay? For instance, something like this, okay? Where if this was a high, and you have this low here, and that's the lowest low we've had for the day, and we're reaching back up to a level where you expect lower prices. As it drops down, that low being pierced here and the later low that forms may not necessarily be the low of the day. But if the level I'm targeting from up here, and I'm aiming for an old daily low, previous day's low, because it's Wednesday today, August 28th, 2024. So August 27th, Tuesday's daily low, there's going to be sell side below that. So if you're inside the range that's reaching down into an old daily low, previous day's low, the first time it goes through that, don't try to aim for your partial there. Don't do that. Let it come back a little bit. It'll teach you patience. It'll teach you holding on to a trade, because it's reasonable to do that. And then once it pierces below that low that formed initially below previous day's low, your first partial's underneath that. Because many times you don't know how far the first drop's going to be. And if you just take something off right below an old previous day's low, you could sell yourself short of a really sizable run. So when you create that short-term low and it retraces back, let it dive down again. And then what you'll do is you'll aim for a partial below that. Now, if you're looking for a more dynamic way of taking a partial, say you're short 10 contracts. Okay, or let's do it this way. Say you're short 2 contracts, and you want to take one off, but you want to maximize the amount that you're going to get on your first partial. You can use this strategy here, where if you're aiming for a previous day's low and you're bearish and it's trading down to it, wait for it to create that short-term low. Then when it starts to break down below it here, every down close candle that creates an imbalance like it does here, this candle's high, this candle's low, you take a buy stop and you place it on one contract, and you place it right above that candle's high. And as it creates lower runs on price, because you don't have the experience yet to determine how far it's going to reach, instead of just taking the partial off just below that low, using the initial outline I've given you here, you can now trail a stop with one contract. So you're not closing the full position. It just means if it goes up there and hits that candlestick there, you'll take a partial on that one contract, leaving the other contract. Remember, the assumption is you're short with 2 contracts. You're just going to trail one with a dynamic trailing stop loss. And you're waiting for it to break below that low first. Once it starts doing that, what it naturally will do, it'll start spooling, which is what you see here. And then instead of just taking the profit right here or something just below the Tuesday's old low and not catching any of this move here, it affords you an opportunity to run with that runner. And as it finally gets down right here, you would be stopped out. As soon as this candle closes, you're going to open here and then bang, you're stopped out. Look how close that is to that swing low. Isn't that wild? And it leaves you open for The core position that you've taken that maybe have been here as an entry or something back here, or if you held on for the daily range from the opening range in the first presentation that we'll cover in a little bit, if you were short here, you got a really wonderful exit on a trailed dynamic partial right there. And then you can weather all this retracement on one single contract, let it bang all around, and you can go for another lower low. And the same strategy being employed here is you want to wait and see, does it run below that low? Let it give you a turn. Your stop loss could be trailed to back to here now. You would lower it down to there, so that way you're not gonna, you won't want to be a part of anything that digs back into Tuesday's low or higher once it creates this type of run. So watching price dive down and make a lower low on the day, and it doesn't have to do it. It's just like a trade management. One of the biggest questions I get a lot is, how do I hold on to these runs that go for hundreds of handles, and like, how do I remain calm? It's taking partials correctly, knowing what I'm looking for, and weighing and comparing what kind of low I'm holding for if I'm bearish. So if I'm waiting for a low to be taken out, is that low a previous day's low, or is it a low that's formed for the day? Like, for instance, this one here. This is our low for the day. So when we dive down below that, you can use that strategy here where you wait for it to go below it and then create the first short-term low. And any retracement on that, give it a chance. Give it a chance to come back in. It can come back up in here in a little bit of that range. You remember your trail stop loss would be up here now. You don't want to be in any retracements back above Tuesday's low. It will afford you the ability to stick with the run. Look at my trade examples. The recordings where I had the stops are just way up there, real close to where I entered at. It's using these types of procedures where I'm not rushing to strangle the position. There are times where I want to put the stop loss relatively, not, oh, look at that dive, isn't that nice? Look at that. Notice what side of the marketplace we're working on. We're not trying to go long. I'm entertained by the folks in other people's live chats, and they'll say, ICT said he was looking for longs, and the whole time we were looking for lower prices. You're funny, I love it. But the relationship to what I'm targeting for liquidity or inefficiency, it may not be something that warrants taking partials, where I just want to just hold on to it for a longer term price run. Now, today we're supposed to be getting news from NVIDIA. Yeah, NVIDIA rather. NVIDIA. I got to sit here on a sticker on my laptop. NVIDIA. And I don't care ultimately what comes from it, but because it's a big stock and there's a lot of sentiment around that one individual company, it creates a lot of buzz. And they like to disturb and mess up the sentiment that's in the marketplace, scare investors or excite investors. And then all of a sudden, after market, the market just goes bananas. Okay. So having that in mind on a day like this, if the market's making lower lows and lower intraday lows, if you're just trying to take a partial or take your profit just because it went down to make a lower low, you miss out on all this runner. So if you're going to try to hold on to a runner, you have to define what that runner is trying to do. What is it trying to capitalize on? Because if you don't have some kind of format or a framework as to what you're holding through, it's not just the time aspect. What type of market conditions are you holding for? Now, because we're breaking intraday, same trading day, low, you can use what I taught you before. Where you take the high down to the low, and you do one quadrant extension. That would be a reasonable place to take a partial, because you're trading what? Below that low. And then you study it. You watch and you see, does it create that short-term low? Does it come back up and try to make an attempt to get back in there? And then if it doesn't, or if it fails to go there and it breaks lower, then you can use that strategy. So I'm giving you a graduated perspective on how to grow into doing it, not just simply saying, well, ICT said this is the best way, so I'm going to force myself into that. And it's going to be hard for you to hold on to runs like this. You'll feel like a deer in headlights because it's running and running and running, and you won't know where to get out at. And it's kind of scary the first time you go through it. So if you remember what we were talking about, I believe it was on Monday. If my memory serves me correctly, I think it's Monday. We were looking at a little bit higher time frame charts. And I was telling you, look at that 19,100 level thereabouts. We had some relative equal lows. If you've taken notes properly, you'll know that that's something I mentioned. And I can't change the recordings that were placed on the YouTube channel, but you'll find that it's there. I think that we may eventually try to get down there, and how we trade below that will be indicative of what we see going into the first 2.5 weeks of September before we go into rollover and then start trading the December contract. The symbols, real quick, just as I'm talking, like I said, I have bullet points that I bring up, and this is why my jawbone takes a lot, because I'm answering questions, and you may not have these questions, but it's important that I refer to the stuff that people are asking. So if it's a lot of people asking the same kind of question, I'll jawbone about it a little bit because it helps them answer it. And it may be something I've said before ad nauseum, but because I have a new wave of new watchers and listeners and viewers of the channel, I want them to have their attention retained. So if they don't feel like they know what you're looking at, they never feel like their questions are being answered, they'll just fizzle out and go do something else and never have the ability to be here and learn like you are. But right now we're trading the September contract. So when you're loading up NQ on TradingView, you're looking at it with that symbol there. That's a little bit too small. So this is September 2024. And then you have the next symbol will be Z for December. And that's for December 2024 delivery. And then when that expires, you'll be trading NQH2025. And that's March 2025. And then I'll just give you one more, because I want to show you all the symbols for the indice. And that's for June 2025. And then after June expires, it starts repeating again in September. So it would be NQU2025. And then when that expires, it would be NQZ2025 for December. And it just repeats. There's only 4 contract delivery months that you have to consider for rollover or contract expiration. And it's usually the folks that's never traded futures that have this kind of confusion. But because we're trading futures, they do have an expiration. And it's the 3rd Friday of every delivery contract month. So the 3rd Friday of September contract expires. The 3rd Friday of December, the contract expires. And then it rolls over, meaning that you can't trade that anymore. You have to start trading the next month out, which would be in this list as I'm showing you, okay? So just take a screenshot of that. That'll tell you what you're looking for. All right. So far we have a little short-term low here. And any retracement up, if you have done the work of trusting that you might get a run better than the high down to that low plus 1/4 of that range, which would have been, that's your first step. Is if you don't know what you're doing partial wise, there's nothing wrong with just getting out below that low, but then watching to see if what I'm teaching you here manifests itself. And then over time, watching it and seeing it occur. The next stage is to wait for it to run deeper and start trailing Your stop loss on one contract would be here, and the next candlestick is right here. So you'd be right there, and the next one is here, and then the next one is there, and you're stopped out right there. And that's not far away from the low that forms. If this is the low of the day, it could be. You don't know. You're very, very close to the low of the day getting stopped out. That it overwhelms you as a trader because you don't know what to do to get out. And this is one of the things I use to cope with fearing getting out at a less favorable place, because I'd always be reluctant to take a profit based on a win I had when I was younger. And I'd get out early and I'm like, man, I wish I would have just held on to that. And I'd beat myself up in my journal. I would do all the things I said you shouldn't do yesterday and what you should be doing. And a lot of you have been very receptive to that. And that was one of the things I wanted you to be giving me feedback on, because nurturing yourself, encouraging yourself with your journal is important, because if you don't do that, no one else is going to do it. No one else is going to do that for you. And you have to have that cheerleading aspect to this, because it's easy to get hurt and then you don't want to do it anymore. So I've given you some steps here to build on holding trades, how to manage a stop loss, but not close the entire position, which affords you what? Capturing big positions, big runners. And if you know what you're looking for, which are intraday highs and lows, that means the highest high and the lowest low since we started trading at 9:30 opening bell. If we're bearish, every single time we've made a low that's the lowest for that day in the afternoon, you have to have that noted. If you've been trading higher, you have to find the highest high that we've made since 9:30 opening. And then every successive lower high or successive higher low. Each one of those lows, for instance, we made this low here when we were trading up here at the beginning of the stream. This was the first one, then this one, and then the low of day so far. So now this is no longer the low of the day, this is the low of the day. So your attention goes to this. And it's a dynamic study of watching how price is continuously evolving, reaching to expand the daily range, or where does the daily range cap, stop, no longer goes any lower or no longer goes any higher. And you study your charts after the close. So it needs to be 5 p.m. or later. And you go through your charts and you observe everything that was in play at that time. What were the catalysts that led to this market dropping like this? We went back to Tuesday's low after going below it. High, lower high. What is this? Relative equal highs. So if that's relative equal highs, what's it doing here? It's just bumping that high and then doing what? Spending time. I saw someone in my private mentorship in one of the user groups, and I watched a few people leave this comment too. You do not want to see price stay in inefficiencies. You don't want to see that. You want to see them spend very little time in them and leave. You want to see, when it's a bearish or premium array, you want to see the upper half not filled in, and you don't want to see it even trade to it. Those are the signatures that I've shared so far. When there is a stop hunt, okay, if it goes above these highs like this and then spends time in there like that, that is the very nature of a fake bull flag. Go into the core content of the 2017 mentorship. It's part of the 2016 mentorship. It's all one presentation, but I started in 2016 of the fall and then ended it in, I think, August of the following year in 2017. But I teach fake bull flags and bear flags and how to capitalize on that. And you're going to find that this is the usual catalyst for it. When the market is predisposed to go lower. And then you have relative equal highs like this, and there's a retracement. This looks like a reversal to someone that's not familiar. The unlearned, they will look at this and say, it's a breakout, it's a bull flag, okay? And they'll start drawing diagonal trend lines on stuff like this and wait for a breakout that never comes. Then you see the displacement here. And then now we have just completely entered several models I've already taught you. Optimal trade entry. $79, $62, optimal trade entry. From high to low, there's your flagship pattern that I had for like 10 years on this YouTube channel. I didn't teach any other model, just kept it real simple. And then there you go, you get the run. The model 2022 is this is my daughter's model, who doesn't trade, by the way. I can't convince her of it, guys. I'm going to accept the fact that she isn't going to trade. So there it is. I can't make her do it. So this is the 2022 model. Okay. And it's beautiful as well. And then you have a Cameron silver bullet. Right there. Institutional order flow entry drill. The lowest hanging fruit objective getting in, bang, hit it. Okay. And it sells off. So you're not short on models. Okay. All of them are profitable. All of them are correct. All of them are potentially used in conjunction. So that way you can enter on a higher one. And if another model speaks to you and says, here's another setup, and it's lower than your initial entry, what can you use that for? A pyramided entry. And you can build the position larger. So when price is trading like it is here, returning back to Tuesday's daily low, that area just above and just below a previous day's low is rich in order flow. It's like a gold mine that can many times be mined. You can go in there and take something out, but you have to know what you're looking for. So some of the things that is outlined over here. And then grade your price swing. So if you think that we're topping out here because we're hitting Tuesday's low, how does it trade once it gets below that low? Is it lethargic, or does it get real quick and sudden and become real heavy? If it does, the easiest thing to do is jump right to the next pool of liquidity. Because if you know this is the low of the day down here, this should not even be a speed bump, this low. So from this low here to that low, it should move to it. And then right before we get to this low, this is the answer one of my students in my private mentorship, because I saw a comment left for this very subject matter. It's also what you see me do when I'm doing my recorded executions. When I'm annotating and I'm expecting, I'll say, I want to see speed and distance, or I expect large down close candles, large bearish candles incoming, something to that effect. Because I am identifying this low here, that low right here. And as we're moving from that low that's been taken out, I want to see how does it behave, how does it trade. And does it remain heavy? It does. And then now right here, we're close to that. and they're not going to want to allow them to pull their orders there. So that's when you anticipate speed. The magnitude of the move should start increasing, and you want to see it get to that low, to it, and through it, and really drive to that level there. Because all of this movement here is tricking traders to think that it's made its low here. It ain't going to go any lower for the rest of the day. That's what retail traders will think. And they'll do all kinds of harmonic trading in here, all kinds of ratio trades. And if they don't know how to take that position off because it's traded to liquidity here, they will hold on to the positions too long, and that winning trade either won't pan out because they're looking for something higher up for a target, or they just hold on to it too long and it does this and then rolls back over top of them. I want to see lows that I'm anticipating and expect to see them targeted as they're trading, and as the daily range is expanding. In this case, it's making a larger daily range with a potential lower close. I want to see, as we trade into the lows that were formed intraday, I want to see it accelerate as it gets close to them, knowing because the low here, anyone that was long, their stop loss is here. Anyone that bought down here, they've trailed their stop loss here once it started going higher. The ones that are more stubborn and say, no, I don't want to rush my stop loss up. I'm just going to keep it right here. They fall victim. These fall victim. But you determine it by watching how you behave below the first low. Once we have that shift in market structure here, that next one here tells you the narrative on how you're going to trade. Is it going to aggressively run for that low? You won't know that until we start to see how we behave there. It trades down below it, comes back up, leaves a small little gap. That's exactly what you want to see. Let me widen it up a little bit. That's your breakaway gap right there. Breakaway gaps form from consolidations or at the beginning of a first stage or second stage distribution or reaccumulation. So if we're looking at this as a market maker sell model, the curve is here. Smart money reversal, low risk sell. This is an area of redistribution. When we break like that, it leaves that little gap. At the time, we pierced that one. That low is the first one after the shift in market structure. This trading below here, this gives you a very obvious level to look for lower prices. As soon as we start to see price drop, the run that takes out that low, if you see that with a gap right here, you want to see it stay open. Expect it to stay open. Can it come up and close it and still drop? Yes. But if it leaves it open, it's kind of like tipping its hand saying, I'm really going to go a lot lower, and it's going to be very fast. So don't be so in a rush to get out of the trade, because I'm going to be moving a lot of distance and a lot of speed. So just hold on tight because we're going lower. And the market dives, consolidates. Look at all the candles, all lower highs. That's heaviness. Then we break again. All the next candles, are they making any higher highs? No, they're staying heavy. And right here, look where we are at that level in relationship to that low right here. We're very close to that. It's only, what, 25 handles or so? So it's going to traverse and travel very quickly over 25 handles. 25 points, if you will, if you look over here, but it's not technically always 25 handles. It's whatever is relative to where the low is if you're looking for it to drop down. When you start seeing it consolidate, but it gets real close to proximity. I don't have any rules, so I can't say like it's this many handles or this many points away from a low. Then that's exactly. It's kind of like a knack type thing, because you can see that we're well beyond from where we are here. And right here, we're closer to getting to that low than retracing all the way back up to here. So I guess if I was on the fly and gave you a rule that I guess could serve you pretty good as a general rule, if the high here to that low is the range we're looking at, as soon as we get to halfway point and below it, and what do I mean by that? It's like this. like this high. I'll fix that in a second. That low to that high. As soon as we get below midpoint, okay, see the fib, halfway point. Let me take those other levels off because we're not looking for optimal trade entry. I'm measuring the range between that low and that high. As soon as you get through half of it, it should start to move very quickly, and it should give you all the indications that it wants to move lower and fast. And what does that look like? Every candle is just staying lower than the previous one. And then when it gets real close to that low here, look how it accelerates real fast. So this drop here accelerates into that low, and you don't want to just see it hit that and consolidate or retrace. You want to see it hit it and drive aggressively down here, because anyone that has their stop loss here, they're toasted there. But the ones down here, we don't even want to see them get the opportunity to go whew, and have a sympathetic sigh and relax, like, okay, I'm glad I didn't have my stop up there, because as soon as it gets below here, it's going to run aggressively in minutes, just like that, to knock them out. And that's how you see that delivery there. So all through this point here, you're going to have the expectation that the market should be heavy. Heavy price is moving lower. Okay. If price is light, okay, it means it's easy for it to climb up and accelerate to the higher reaching premium levels. But heaviness is always something that's bearish. It just indicates the characteristic of price action having very hard times climbing up or even making higher candle highs. Just study all that stuff. These are very important things because it will repeat. It's not just this time. It's like this majority of the time. And if you learn to wait for setups that have a lot of things going for you, and it starts showing these types of things in price action, and you're attacking lows, because we're not trading support and resistance. We're attacking people that use support and resistance for their liquidity. It goes without saying, I know that people have bought something in here, or they put a stop loss below that and chased it. Maybe they bought a bull flag here. Maybe they bought in here. Maybe they bought an order block here. And they just don't know how to hold on to a trade and exit at the right time. And then all this here, they're going to watch their stop loss get hit, because that's what they're going to anchor it there, or here for someone's a swing trader. So we're targeting the liquidity. We're targeting support to get the sell side below it. We're targeting resistance to get the buy stops or buy side above it. And we're using the underlying narrative based on the session time of the day, based on the day of the week, based on what the week is likely to do, based on what the monthly chart is indicating on a longer term basis where it could draw to. So when you start blending all these things, Caleb, you get a real rich tapestry of what price is likely to do and how it should behave and perform. All right, so that's the teaching part for today. As I don't want to be talking too much when the macro at 250 starts. So I'm going to be looking at price. So here, all in this consolidation, we're at 386 and a quarter. Okay, look at the chart on the right hand side. Look at this one over here. Okay, whatever I'm doing over here on this chart, annotating on the 1 minute chart, the price is being highlighted in the same price on that 15-second chart. So when we go to this area over here, you can see how price creates that little gap in here, trades up to here. This is all 15 seconds, and it drops, remains heavy, small little volume imbalance. Right there. Wick, halfway point. It can go above halfway point because it always, you can allow for a little bit of movement above it. That's a mohawk. What did it really do? It just went in here to get that covered up. They laid down another candle over top that volume imbalance between that candle's close and that candle's open, and then breaks lower. Immediate rebalance. Drops. Small little volume imbalance. Comes up. Overlaps it. Drops. Volume imbalance. Trades up. Bearish order block. Two things are being done. Order block. Volume imbalance. Trades up here and then dives again. Immediate rebalance. Drops. Accelerates lower. And if you were using trailed. You don't want to trail your like if you have multiple position size, you have 2 contracts on or anything higher than that, and you want to take something off and you want to do the dynamic trailed partial. So you're going to be using it on a 1 minute chart. Never, 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 never do it on sub 1 minute, because you're going to have so many candlesticks that these lower time frames can overlap a little bit more and look a lot more spiky, fuzzy looking versus what you'll see on the 1 minute chart. So the dynamic trailed partial, where you're holding and you're not taking a limit exit when you're short to take a partial. You're not aiming for any specific level. You're letting the market decide when you're going to get out, and you'll be able to capture the biggest runs. You can do that same style if you want to take out all of your trade too. Like say you had 2 contracts and you start trailing your stop above as it's diving into the liquidity. If you do that, it'll afford you a lot of hold time to capture that bigger lines portion of the run. Another form of doing it is you can go back 2 candlesticks. So as it breaks lower, you can go, all right, you don't want to use it on this one. When this candle opens up, you don't want to use that high. It's this high. And you trail it down that way. But that to me is more appropriate for when you're swing trading and you're holding for a trade that's going to pan out over the week, not intraday, because that's a little bit too much of a range to give back, in my opinion. So if you trail it down ultra tight to whatever the previous 1 minute candle high is, and be content with, if I get knocked out of this, I'm so close to where the low is, I'm okay with it. And you have to make allowances for that. If you're going to beat yourself up and say, no, it's not good enough, you're going to have the problem I've had for 32 years where exits that are so good compared to everybody else aren't going to be good enough for you. And it'll be easy for you, even though you're not supposed to be doing anything negative in your journal, you'll harbor those things inside and you're like, I want my exit to be better. When these are phenomenal exits, these strategies on trailed stop loss management and how to hold on to a trade longer and how to take a partial, like it removes all of that necessity for you to know what's a good level to take partials. Well, now you're giving yourself the chance to ride it a little bit more. Like you're riding the lightning with something like this. And why would you want to sell yourself short? To get out, not no pun intended, to get out of the trade prematurely and not afford yourself the opportunity to get a larger portion of the win without incurring any more risk. You're not doing anything that's going to, elevate the level of risk. You're not over leveraging. You're not even adding to the position. You're just managing one part of the position. The one contract or whatever the partial is that you intend to take off, whatever that is, you're just managing it on a trailed buy stop for that number of contracts. And if it hits it, knocks you out, you still have your core entry. Whatever your entry is based on the averaging of your pyramided position, whatever that last adjustment is, like say you sell short, then you sell short more, your average price will change. It'll usually start to move closer to where you're aiming for. That's why when you watch me do a pyramided entry, it doesn't maintain the high price. It just averages based on how many contracts I'm selling short or buying, and it reflects that average price. So, because if the market goes back to that price, then you'll start losing money if it's not done correctly. For instance, say you did 4 contracts here, or I'm sorry, say you did 4 contracts here and you did 6 contracts down here. You might have some problems with drawdown there. You might see it go below waterline. That means you might see a little bit of red before it starts rolling in your favor and start making profit on the position. Unrealized profit, but nonetheless profit. So real good strategy for answering the folks that were asking how to take partials better and how to aim for partials. This way, it removes the whole necessity for aiming anything. You're just holding on and letting that bull run, or in this case, a bear. You just grab a hold of its fur, close your eyes, and just don't let go, and see how far she'll run. And it allows you to get knocked out many times, real close to the low, which would have occurred right on that candle there, knocking the high out of that one. Look at that from 278.5, and you get knocked out at 302 3/4. Chances are you're probably not holding for runs like that because you don't know how to hold on to them. You get scared, you're nervous, or you're second guessing yourself. You don't know what liquidity to aim for. This completely removes all that and just allows you to mechanically be removed, and that way it's an objective strategy. It's not something that you have to think about too much. All you have to do is watch every individual 1 minute candle. And as it's starting to run, all you're doing is dropping your stop loss down to the previous candle's high. That's it. It's very simple. So we're going to look at the morning session real quick, and then we'll wrap this up, and I'll watch the last hour with you. If you liked what you just learned about the dynamic trail partial and that strategy, give the live stream a thumbs up. Nobody will see it. It's just for me. So we have this liquidity here, this high, and this high. That's what I was looking at. If you looked at this high and this high, that's not meeting the criteria that makes what? A high probability relative equal high. Because this high is slightly higher than that one. But this high is obvious and you can see it. So I like this one. It's just above here and here. And that's the one I gave in Tanya Trade's live stream today. So if you look at her video on August 28th, 2024, just watch right before the opening bell, like when we were in here like this, I was outlining, I told you this candle right here is going to be an inversion fair value gap. Before it was an inversion fair value gap. And the way you can determine that is look at the chat in her live stream, and in the settings, click timestamp, and you'll see me call that very candle there on a 1 minute basis for NQ. It's an inversion fair value gap. And I mentioned the minor buy side liquidity based on this candle's high. Okay. And it rallies up off of the inversion fair value gap here, hits that liquidity. And then I said, well, if you had something there and you partialed off, you have a free look now to see if it can run higher. We don't have a first presentation of a fair value gap yet. That doesn't occur until here. Now here's the part that a couple of my private mentorship students and some of you in the comment section, because these sessions are long, okay? And I'm seeing a lot of you say, please don't make them so long. I'm not able to keep up. Stop trying to keep up. Just take your time. I want to teach it to you properly, okay? Because it's my son who I'm teaching. I'm not answering everything for you, but some of the questions are good, so therefore I will ring them into the next presentation. But there are some questions that I'm not going to address because I've already talked about it literally in the previous 2 or 3 streams. But because you don't want to watch them entirely, or you're not writing down as you hear me say certain things, I'm answering a lot of questions that people have had for a long time in this mentorship, even paid mentorship students. So this candlestick here is 930. This run up, and then as soon as this candlestick here closes, you cannot qualify that as a fair value gap to use. And this blue shaded box, we're going to take that off because it's the opening range gap, and I'll show you how it's formed again here so that we have a complete rundown of what it looks like again. But this is not a fair value gap because the imbalance candle, or out of a 3 series candle pattern of fair value gap, the middle one is the inefficiency and the imbalance. So here, if you look at that 930 candle, that candle doesn't exist in regular trading hours. When you toggle that, you're not going to see the difference between 414 and where we open up at 930. That's 2 candles. You need a third one, and that's this one here. It's always going to be 931. So 931, that's the earliest, that's the soonest, I had it right the first time. The earliest formation of a fair value gap between 9:30 and 10 o'clock can only form, based on the rules I'm giving you, as early as 9:31. So you have to get that first minute past you, and then you can create a fair value gap on the 931 candle if the 932 candle affords you the structure or the presentation of a fair value gap. And we don't have that here. The first formation of it is here at 935. Okay, so at 935, I'm going to maximize this chart here. At 935, This is a Judas swing. It takes up the liquidity I gave to Tanya Trades viewers. When I'm not live streaming, okay, and if I'm not doing something in my personal life, I'm usually there supporting her in her stream, okay. There's two other people that I watch. And I use their chat window, and I also support their channel because I like them personally. So, but I'm usually active in the chat on Tiny Trades live stream. Why am I there? Because she reminds me of my daughter. Okay, I'm not lusting after her. So for the sickos that puts that stuff in the chat, it's disgusting. But this candle here is not a fair value gap, so you cancel that one out. Start looking for the fair value gap at 931 to form. Is there a fair value gap here? No. Is there one here? No. 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 This one isn't one because this candlestick overlaps with the previous candle's low. So there's no gap there. This one we break down, and the next candle we open and have a run up to this high here. I'll take this away so you can see it. See the fair value gap now? It's obvious, right? It's clear. It's easy to see. Real easy to see that. Nothing in here is a fair value gap until here. So your fair value gap for Wednesday, August 28, 2024, forms on the 9:35 1-minute candle. There you go. So now we break down below the candle I tell you before this run up in Tanya Trades live stream. I tell you, look at the 8:15 candlestick. That's an inversion fair value gap. So here it looks like it should come down and be treated as what? Bullish fair value gap. That's what you're thinking, right? If you think you understand what I'm doing and without understanding the logic, you think that that's what this is. It's go long. But I called that initially, first comment in her stream mentioning any fair value gap was that candle at 8:15 is an inversion fair value gap. And then I told you that this is the minor buy side liquidity at that price level right there. So it was based on this high and that high being relatively equal highs. So the buy stops up here is a minor buy side liquidity pool. The market breaks lower into the inversion fair value gap. Are we trying to buy it? If it's an inversion fair value gap formed like this, no, we're waiting. Okay, we're waiting. We want to see it trade down. And what does that give us then? It gives us the potential to see if it goes below it, and then does it allow for this same fair value gap to stave off any higher prices. But if the market trades just outside of your PD array, which is this one here, which was called an inversion fair value gap before in front of the live audience over there, so she has a timestamp feature and her chat's there. I can't edit what she has there. I can't hide anything, and everybody saw it when I did it. It rallies up, and just outside of the inversion fair value gap, this wick comes all the way back up to first presentation. That's the fair value gap here. So we went below the inversion fair value gap. We left the opening range gap, which I'll show you in a moment, but we're trading up into it here. And I said, when it gets there like that, I said, it's hitting the bottom of the opening range gap and inversion fair value gap. Look for August 16th, new day opening gap, and August 27th, maybe getting down into that on the first pay, driving down in there. You can go see in verbatim what I actually said and the timestamp that it's occurring, and then look at your chart, and then price does it. People watched it happen. They watched it happen on the Judas swing right here when I called it from there up, and then here as a sell-off using first presentation there. The bottom of the opening range gap, now if we go into regular trading hours, go over here and toggle that. That's this big candle here. See that? Now, if you're using regular trading hours, you can see how opening at 9:30 here and then closing up here and then using the previous candle at 4:14 on Tuesday. Notice the time at the bottom of the chart down here. It's 4:14 yesterday, Tuesday. Then we opened down here. So the gap is from where we settled at 4:14 and where we opened. That's the opening range gap. This is a discount gap. That means it's an open that's lower than where we settled previous day. And then it's likely to do what? Half of that range within the first 30 minutes of trading. So you annotate it here, put it on the opening price, and you draw it up to the settlement price. And you make your little rectangle here. And then because it is a premium, I'm sorry, it's a discount gap, mine's blue, okay? Meaning that I'm trying to communicate to you, I don't have this stuff on my chart, I only have it to teach it to you. I'm looking at from that opening price here, can it get back to that price level here? So if I'm expecting that to occur, what am I expecting in price? Buy side delivery. That means up movement in price, going higher, rallying basically. So it needs to go to that price level here, but minimum expectation is in the first 30 minutes, 70% chance that it's going to go half of that gap's range. Here's electronic trading, opening at 9:30. That lower level also happens to be new day opening gap from yesterday at 6 p.m. Eastern time, and the difference between 5 p.m. yesterday's closing price. It's only 2 ticks. That 2 tick here is overlapping with half of that opening range gap. See that? So we open, half the gap is hit, full closure of the gap is hit, and then it does this. Sweeps above the buy side. Here and over here. So there's 2 things happening there. You can be a buyer inside this inversion fair value gap, because at this point here, there, it's going to act as a reclaimed fair value gap. Initially, it should, if you don't know what you're doing, you're not going to find success here. It trades through it. Then we get to the time of day when it needs to be delivering. It's consolidating here. It's an inversion fair value gap, meaning the original classification was it should be expected to be used as like a level to send price higher. It's a discount. So it's something to buy. But when it does this run to the liquidity, if we break down below it, it's used as a catalyst to send us as a premium and then drive prices lower. Here, it's a bullish fair value gap. It's not the right time to take that trade. We're minutes before what? 9:30 open. So the market's just waiting. And then when you're in here, you're right before the opening bell, minutes before the opening bell, just so happened to be at a few minutes before 9:29, and at the opening bell, it opens and then hits the gap. And what is it doing? It's using it as its original form over here, but only going into the buy side I outlined. I'm more inclined to use that gap as an inversion fair value gap. I want to see it do this. If it happens to go below it, and then it leaves behind in its wake, dropping down, it creates that fair value gap right here that's shaded. So we have 2 things forming there. We have the bottom of that blue box, which is the opening range gap low, which in this case is the opening price at 9:30. And then we have the return back into this gap here on that pass. So 2 things are happening right there on this. We're trading into the inversion fair value gap. So you could be selling short here, midpoint, and then the drawdown is, can you take that trade if it trades up into this gap? If you can't, try to get a fill just below or the low of that first fair value gap that forms. Because the narrative's set in motion now. We have a shift in market structure. Liquidity's been taken here to here in return. That low of the opening range gap being tagged right there is doing 2 things. It's returning back to the opening price at 9:30, and it's going to the first fair value gap that formed between specific 9:31 and 10 o'clock. Does it, look closely, does it close the upper half of that gap? No. Isn't that what you want? Yes. So what happens if when it trades up there and you don't get into it there because it's too fast or you're just not on the game? Like you just can't bring yourself to enter the trade. When it trades back down into the inversion fair value gap, you can short there and use what this high is plus one tick. How can I trust that ICT? Because if you have what I'm outlining here and what I outlined in Tanya Trade's live stream, this is going to act as an inversion fair value gap. And if it's going to run up here with a wick, because we opened here on this candle, it opened there. And to get to that level here in one candle, if it's going to go lower, chances are this is going to form some kind of a wick, right? So if that forms a wick and you're trading in it here, you're putting your stop loss one tick above the high. What should form after that wick? Worst case scenario, another candle with a wick that's only going to go about halfway of this wick. Oh, that's why your trades are never nervous. You're not worried about it. No, I'm not, because I know what I'm looking for. I know the logic I'm looking for, but it doesn't even give us another candlestick to even try to approach outside the other end of this or the high of the inversion fair value gap. So it's really heavy because it goes up there, hits the first fair value gap that I taught you. All this stuff keeps repeating, doesn't it? This is still too early for you to fall in love with it. You might be smiling and think to yourself, wow, yeah, I can see it. I didn't see it when it was happening, but I can see it. It's really there. Wait till you have a couple months of you journaling this and you have example after example after example. Your mind is going to be formed pursuing these types of setups. They're not hiding from you. They can't be hidden from you. There's nothing to worry about if you can't see it right now. Fall in love with the meditation of capturing, collecting these things day by day. Getting screenshots like this, just like this right here. Saving it just like that. And then seeing how that first fair value gap between 9:31 and 10 o'clock is used. And we hit it, it hammers it and drops down. And then now look at what, excuse me, look what else happens. We have this old area of new week opening gap, new day opening gap. Look how many times they've used these levels. How many times it's traversed back and forward and through. But when there's time of day that I'm teaching you to focus on, when the algorithm will refer to these levels as key important factors and arrays, they use them. New day opening gap, low, the bodies, hitting the low of it, dropping down, leaving this gap here. This gap is a breakaway gap. What makes this gap a breakaway gap? Because we've had this initial run that starts the run lower. If the market's going to trade to a first presentation fair value gap between 9:31 and 10 o'clock, and it's going to drop, once it starts to run, you're anticipating this occurring. This is like a signature, like, yes, now we're going to be really running. You don't want to see that close in. It can come back up there and close it and then drop later on. It's just better that it doesn't. Sometimes you've seen my trade executions where I'll annotate something. Ideally, I want to see this stay unfilled, and I'll mark it as a breakaway gap. Sometimes it goes down and fills it and then still does where I want it to go. It's just better. It's just like a sugar coating, a cherry on top to what you're already doing right. Okay, the price is going to go where you think it's going to go if the trade's right. But these are things that you really want to have as hallmarks in your winning trades. They're not always going to be there. They can still close in, rebalance to that point and send it lower and still be able to hit your target. It's just, I want to see this because that means we're heavy. We can't even fill that back in. And the market's going to drop down into the targets I gave in the live stream, and Tanya Trade's witness of everybody was over there. She had like 3,600 people in there. And the new day opening gap on August 27th, that was hit. And initially is August 16th, new day opening gap. And we dug down, swept below both of them, did all this little cruddy price action in here. and it came right back up to that gap that was later on traded into here, but a portion of it was left open, and then it rolled over. I worked with my private students in here, all of this run up in here, and then we worked with this area here, attacking Tuesday's low there. But all in all, oops, didn't want to do that. Pretty fun day today. Lots of nice movement. All right, so here's where we're at, what we've done so far. So I'm just watching what we're doing going into the last hour. So I probably won't be doing too much talking until I see something that's worth mentioning. If you're satisfied with, this is the part that was the teaching, that's done now. So if you want to come back and watch this part at a later time, you're welcome to do that. I'm not going to call trades or anything like that. I just want to do an observation with you live. Main takeaway today is everything I'm teaching you, it's repeating. The things that should form, when they should form, they're forming. And when they are formed in price action, price is respecting them in a manner that allows and affords you opportunity to engage it. It's a tradable setup. It's a tradable framework for market structure. I'm just going to minimize this one so we can have both the seconds chart, 15-second chart, and the 1 minute. All right, so we are inside the 250 algorithm. It runs till 10 minutes after 3. See the volume imbalance in here? If you have the ability to pull up 15-second charts, these are things you want to look at. This price run here to this. We have a small little inefficiency here. Things like this, you want to screenshot it, and you can go back through the price runs. These types of runs happen all day long. They're there a lot. So this little gap right here, formed by this candle's high, and that candle's low, right here in the left-hand side chart, right there, that candlestick right there. There's your imbalance, and here is your low of the candle that forms the low of the fair value gap. It's a SIBI because it's a down closed candle. The price run in here, there's several things you want to take a look at. From the 1 minute chart, you can see how and this is how, Caleb, you're going to identify things that repeat over and over again, and it trains your eye to see things that will repeat, and your eye will see it in real time, and you'll know that it's likely to behave a certain way because you've seen enough examples of it. Okay, so you have an order block. It rallies above. As soon as it crosses this candlestick's opening price there, that's the change in the state of delivery. Over on a 15-second chart, how far into this decline can it go in this candle when it was dropping on this 1 minute and this 1 minute candle? How far into this can it go? Well, you don't want it to go past the halfway point because mean threshold is the most sensitive price point and to its high. In this case, it's the opening price. So that's where it's going to be most sensitive to. If you're seeing it drop down into that and below that level here on a 15-second chart, isn't that pretty? That volume imbalance right there, you see that? See that right there? And the market trades down to it right there. It does its work there on the 15-second chart. So the algorithm sees this here. It drops back down to a discount relative to this delivery and price. Then over here, it's cycling through the lower time frames, and wherever there's any inefficiency, that means a gap, fair value gap, or volume imbalance. In this case, there is no fair value gap here. There is no swing low because that's already happened here. So stops were taken there. So this delivery went below that low. Then we rallied. This little inefficiency there, that volume imbalance, is all that the algorithm needs to do on the 15-second chart before it starts to rally. Inefficiency here. So on this run there at 250, when the algorithm starts, right there, this creates an inefficiency. Buy side imbalance, sell side inefficiency. If it's starting at the beginning of the macro at 250 and it's wanting to go higher and run for this inefficiency here on a 1 minute chart, because now we're running higher, it's looking for inefficiencies that are premium relative to where we are at here. Where's the buy side? Here. And then what happens if it goes above that? That's the inefficiency. Inefficiency. And we can go back to Tuesday's old daily low. But you just don't want to go in here and say, oh, it's just going to go to Tuesday's daily low and just that's it. That's not properly managing the range that you're dealing in. This high down to that low is the dealing range. So when you look at what price is done here, this on a 15-second chart will act as a breakaway gap. And you want to see things like this, institutional order flow entry drill, where it just goes into that gap formed by this candle's high. Every time I do it, see? Every time. There you go. So institutional order flow entry drill is where it just goes inside and leaves the maximum amount of the range open. And when it starts to run like that, that tells you you have a breakaway gap. And that starts at the beginning of the macro at 250. See? Right there. See the time? 250 on the dot. And then it rallies up. Trades into the low of this inefficiency here. Hits it, stops dead in its tracks, drops back down, consolidates, and what's it doing? It's accumulating before it does what? Rallies to a deeper premium, which is consequent encroachment of this inefficiency. Does it stop? Does it respect it? Just stop short of it, opens slightly higher, comes right back down, touches that right there, volume imbalance. Rallies and goes to the high end of this inefficiency. Does it respect the high of it? No, it goes right on through it. Opens, trades down to the high of that inefficiency. So now what is it acting as here? This gap is a target to draw price up into it. And now when we're above it, how should it behave? Let's assume for a moment you think it's going to go to this gap right here. Or do you think it's going to trade back to Tuesday's daily low? If that's the case, and this is your terminus, say this is your terminus and this is a partial. So this is your next upside object. Let me put it on the chart. If it feels like I'm going too fast, or if I'm talking about things that seem to advance, I promise you're going to see me doing it more and more. And the things that you have questions about, because I'm going to talk more about them because they repeat every single time, it'll start becoming very clear to you, and it won't be that big of a deal. So don't be discouraged, is basically what I'm saying. We trade down to the top of the inversion fair value gap that this will become if we're expecting this to be traded to and draw back to Tuesday's low. So it trades here. You would expect it to start showing you indications that it wants to go higher. Does it go higher? Yes. Drops back down. What's the middle of these wicks? Lowest one, measure that one. Trades to it here. Sends it higher, yep. Middle of this gap or wick. Every time it jumps. Look at a perfect delivery on the bodies. You see that? That's algorithmic, folks. And it rallies. Here is your order block. It leaves it. That's a change in the state of delivery. Right there. I won't label it this, but that's a bullish order block. And the upper half is the most sensitive point. Trades into the upper half of it. Just the wick, because that's what's allowed to do the damage. The bodies are supporting the fact that, okay, yeah, we're respecting the order block there. Price should rally. Where should it rally? Here. Once it takes out that high, if it's going to trade to this volume imbalance on, fair value gap over here on the 1 minute chart, it should do it quickly. It should pierce right through that and not dilly-dally around. Does it do that? Yes. Rallies, runs up. We're just falling short of Tuesday's daily low. We just hit it now, and ICT did it once again. but I'll never be able to call it live. When I'm able to do it live, I'll start live streaming. I promise. I promise you, when I learn how to trade and I read the price correctly, I'll come out here and I'll start doing it in front of you live. Okay, but until then, you're just gonna have to take these pre-recorded videos using delayed data. I'm not going to do it here, but I shared with my private students a message that somebody left me saying that these trades are fake, and here's why they're fake. I'm using delayed data, and I'm sliding my stop loss, and you can't do that with live trades. And I don't know where that person got that idea from, but you need to learn a little bit more, son. So there's the afternoon outlined. You'll see a lot of these price runs for months before you start taking them, okay? Because you want to get real comfortable seeing them, expecting how they're going to deliver, and seeing what framework you'll use for your own trades. You'll also see the characteristics, the mannerisms that these PD arrays will behave and how price uses them. But you can't argue, okay, that there isn't an algorithm, because at 250 I taught you that it will start spooling. That means it's running. Think about it like this. Here is the 250 candle right there. And say you're a fisherman and you have a fishing rod in your hand, and you know that there is a lot of fish sitting around the previous day's low. There's a lot of interest. Many people want to buy if it can get back above the previous day's low after going deep. That's a mechanism that some algorithms fire up and you run on it. But the casting of that lure, if you will, on a fishing rod, if you plan on engaging and trying to capture fish there, that's your target, that's your terminus. So here's your fishing rod. You're casting it in that direction. Well, this is the fishing line spooling off of that reel. When you land that area here, that's your fish. You just reeled in and you're done. That's your trade for the day. And it's occurring exactly at 250. But there's no algorithm. I refute ICT's claims that there's an algorithm. I love that you're refuting it. I love that people make those videos. I love that there's doubt. I love it. I love it. And there's always going to be new doubters. And I am so thankful that I am in a position like P.T. Barnum. I have a line of suckers coming in, not believing the truth I'm showing and proving to you, that would literally hold up in court that these things are absolutely controlled. They're programmed, they're coded. You can see it. It's not surprising. There's no reason for you to be like, oh my goodness, why did that happen? You're just simply waiting for the things that you're expecting to see in price. Think, folks. Am I twisting your arm to stay here? No. Am I asking you for anything? No. Just take your time so that way you learn it correctly. Don't hold yourself to an expectation that's too high and lofty, okay? But that's going to be it for today. This was enough. It went back to our level of interest. We went and behaved a lot of PD arrays delivered as we would expect. Be content with this. This is more than enough, folks. More than enough. And I will be with you, Lord willing, tomorrow at 9:20ish, something like that. Hopefully I'll be on there before 9:30 opening bell. Sometimes it just doesn't work out like that, and I'm doing my best to be there. But I'm here every day, but I might be a few minutes late. But tomorrow we return back to a morning session, and we'll do the same thing on Friday. So Thursday, August 29th, and Friday, August 30th, 2024's live session will both be morning sessions. But I will be stopping them both at around 10:45. In other words, I'll close the session before 11 o'clock. Let's just say it that way. If I go to 11 o'clock, it's not like I'm lying. Okay, and I'll talk to you guys then. Until I'll talk to you then, be safe.